Welcome to our deep dive into hedge accounting. In this video, we'll unravel the complexities of hedge accounting, provide illustrative examples, and help you understand its practical applications. Let's get started. Before we jump into hedge accounting, let's establish what a hedge is. In finance, a hedge is a method to offset or reduce exposure to various financial risks, especially currency fluctuations, interest rate changes, or commodity price shifts. Hedge accounting is an accountancy practice used to manage the volatility associated with hedging. It aligns the financial reporting of hedges and the underlying risks they are mitigating. There are three main types of hedge accounting: fair value hedge, cash flow hedge, and net investment hedge. Let's explore each of these in detail. A fair value hedge is used to mitigate exposure to changes in the fair value of an asset or liability. This includes items such as fixed-rate debt or equity investments. For example, suppose a company issues a fixed-rate bond and fears that rising interest rates will decrease the bond's fair value. The company can use an interest rate swap to convert the fixed-rate payments into variable-rate payments, thus hedging against interest rate risk. A cash flow hedge is designed to hedge exposure to variability in cash flows of a recognized asset or liability, such as anticipated transactions affecting company earnings. Consider a company that expects to purchase a significant amount of raw materials in the future and worries about price increases. The company could enter into a forward contract to lock in the price of the raw materials, thus stabilizing future cash flows. A net investment hedge is used primarily in hedging the currency exposure of foreign investments. It is particularly relevant for multinational corporations. Imagine a US-based company has a subsidiary in Europe and wants to protect itself against the euro weakening against the US dollar. The company can use foreign exchange forward contracts to hedge its net investment in the European subsidiary. Now, let's address how hedge effectiveness is measured. Measuring hedge effectiveness is crucial in hedge accounting to ensure that the hedging instrument is appropriately mitigating risk. There are two key methods to assess hedge effectiveness: the dollar offset method and the regression analysis. The dollar offset method compares changes in the fair value or cash flows of the hedged item to changes in the fair value or cash flows of the hedging instrument. Suppose a company has a fixed-rate bond, hedged item, and an interest rate swap, hedging instrument. To measure effectiveness, we compare the changes in the bond's fair value to the changes in the swap's fair value. Regression analysis involves statistical methods to assess the relationship between the hedged item and the hedging instrument over time. Imagine a company using a foreign currency forward contract to hedge an anticipated foreign currency transaction. By conducting regression analysis, they can assess the strength and validity of the hedge relationship. To give you a numerical clarity, let's examine data points for a company executing a hedge using regression analysis. Let's answer a common question: why is hedge accounting important? Proper hedge accounting ensures financial statements accurately reflect the company's risk management activities, providing a truer economic picture. Investors need to understand a company's actual risk exposure and how well it mitigates those risks. Hedge accounting improves transparency and comparability in financial reporting. Now let's discuss the requirements for hedge accounting under the International Financial Reporting Standards, IFRS. According to IFRS 9, for a hedge to qualify for hedge accounting, it must meet specific criteria. The criteria include formal documentation at inception, a clear economic relationship, and hedge effectiveness. The documentation must specify the hedging relationship, objectives, and risk management strategy. Let's consider an example of hedge documentation. A company hedging foreign currency risk would need to document the exposure, the hedging instrument, and how effectiveness will be assessed. A crucial part of hedge accounting is continuous monitoring and management. Companies must regularly assess hedge effectiveness and adjust hedging strategies as needed. In practice, continuous monitoring may involve revisiting the hedging instruments, examining market conditions, and reassessing the hedging relationship. To sum up, accurate hedge accounting requires a comprehensive understanding of the types of hedges, effectiveness measurement methods, and strict adherence to accounting standards like IFRS 9. Thank you for watching. Please like, share, and subscribe for more in-depth financial insights and tutorials. See you in the next video.